A number of people said they couldn't put the trading symbol for the Shanghai gold in dollars on their machine. I have TradingView. I have a premium version, so maybe you have to have a premium version to see futures prices. But just if you want to try it, first of all, don't put this into the futures section of TradingView. Put it into the general section, just where you have all the other prices of everything. And the symbol, just to repeat for those who are interested to see the futures price or in Shanghai converted to dollars, is. Today I'm going to be talking about the precious metals again. There's a lot going on and we need to see what's happening there. So silver. First of all, silver, it's at $71.70 on the spot market. That's a nice rise of about 0.6% from yesterday. Some might say it's a bit more than that, depending on what time you measure it from. Gold is at 4,480, literally unchanged from yesterday's price, but obviously that's an all-time record, as it is for silver. Let's just talk about silver and the Shanghai price. Shanghai, silver is trading at, I got it here, $77.12. I repeat that, $77.12. That is a record premium over the Western price of 71.70. It's more than $5 ahead. Yesterday I said it was something was breaking because we were $3.50 ahead. Now we are over $5 ahead in Shanghai. What that means is there's a literal shortage of physical metal, because if the physical metal existed, if it could be found, it would be immediately shipped to Shanghai and arbitraged away, so there'd be no difference between the two prices. Now, normally there is a difference between the Shanghai and COMEX price. Typically the difference is 50 cents or $1, almost never more than $1. But in the last couple of days, that difference has shifted significantly higher, basically meaning that people are unable to do the arbitrage because they can't lay their hands on the physical metal to arbitrage it away. So we're now in a situation where the prices are getting distorted. What is the real price? Is it the $77.12 in Shanghai, or is it the $71.70 in the Western markets? What's going to happen? Will the Western price of 71.70 continue rising until it matches the Shanghai price, or is the Shanghai price just too high and people are going to start selling in Shanghai? But that's not the case. It seems to be that there's strong buying coming out of China and pushing the price higher. But we don't know what will happen. But I'm just telling you, it's a very, very tight market in the physical side.
Under normal conditions, price differences between Shanghai and Western exchanges are small and quickly arbitraged away. That mechanism appears broken. The current premium implies that physical silver is not readily available to move between markets. If supply were ample, traders would rush metal into China and erase the gap. Instead, the premium keeps growing. This strongly indicates a shortage in deliverable metal. With industrial demand rising, especially from solar energy, electric vehicles, and electronics, China's appetite for silver has intensified, reinforcing the idea that physical constraints, not paper trading, are now driving prices.
Now, I did ask yesterday what the lease rate was. I said that about a month ago it was 7 to 8% for leasing silver. Any lease rate above 1%, or above 0% really, indicates a sudden tightness in the physical market. So why would a lot of people said, why would anyone in their right mind borrow silver when you can, but just get in the market? Makes no sense to pay 7 or 8%. By the way, a couple of people wrote to me and said the lease rate is currently 30%. I don't know where they got that figure from, because I can't find it and I can't prove it. But let's just say that that might be an accurate number. If it is, the question is, why would anyone borrow silver? Well, there's two types of borrowers of silver that I know of. The first type is the shorts on Wall Street. So these would be the bullion banks who typically play on COMEX. So what they do, they basically sell the futures, because the futures typically trade at a higher price than the spot price. And when the future gets to maturity, they then roll that into a futures contract. So constantly they're selling high at the future month and buying low, buying back the contract when it reaches maturity at a lower price. Nice, easy, guaranteed profit, or so it seems. But what happens when the future they've sold, they're asked to deliver the physical metal, which is historically an unusual situation, but it seems to be going on now. Well, then they've got to lay their hands on the physical metal. No problem. They can buy it in the market, unless it's not available in the market, which has been the case recently. And so what happens then is that they have to try and source the metal from somewhere else. And the only place you can source it from, if you can't buy it, is to borrow it. And that's why, one of the reasons why the borrowing rates are going so high, at above zero, or above 1%, let's say. No, I stress, I don't know the borrowing rate at the moment, but a lot of people are telling me it's much higher than 1%. I had actually 2 or 3 people messaged me, someone saying it's over 30%, and a couple saying it's 7 to 8% at the moment. But the point is, it seems to be, for those in the know, it does seem to be above zero. The other people who would borrow silver are the manufacturers in the auto sector, the solar panel sector, the electronics sector, even Apple. I mean, all these companies need literally tons of silver for their manufacturing process.
Another warning sign is the surge in silver lease rates. Historically, borrowing costs near zero suggest abundance. Elevated rates imply scarcity. While exact figures vary, even modestly positive lease rates point to tight conditions. 2 groups typically borrow silver. The first is large financial players who sell futures contracts and must occasionally deliver physical metal. If supply is unavailable, they are forced to borrow. The second group is manufacturers. Automakers, solar panel producers, and electronics firms cannot pause production. If silver isn't available on the spot market, they must borrow it, at almost any cost.
And if you don't have it, you have to buy it. And it doesn't matter what the price is, you have to buy it at whatever the price is. But if it's not available, you still have to get some, because you can't stop the manufacturing process while you wait for the refiners to deliver the silver, which might take another week or a month even. You have to keep getting that silver in the door, and of course with just-in-time sourcing, which is very much the thing these days. If it's not available on the spot market, you have no choice but to borrow it. So again, the borrowers can include manufacturers, and the high lease rates is the indication that silver in the spot market is in short supply. So today platinum is fractionally down. It's down 0.84% at 2270, but of course it was only a few days ago, it was well below 2000. So it's had a very good performance in the last few days, and palladium is down a bit more. And palladium had a really good performance yesterday, up 5%. Now it's down 5% today. It's down 5.75% at $1,753. From the studies I've read, both platinum and palladium are in short supply this year and will probably be so next year. But from the studies I'm reading, it looks like the supply and demand for palladium will come back into balance and go into a surplus in future years. Yet the supply and demand for platinum remains one of platinum deficit, i.e. not enough platinum being mined for as far out as the eye can see, which is 3 or 4 years. A number of people said they couldn't put the trading symbol for the Shanghai gold in dollars on their machine. I have TradingView, I have a premium version, so maybe you have to have a premium version to see futures prices, but just if you want to try it, first of all, don't put this into the futures section of TradingView, put it into the general section, just where you have all the other prices of everything. And the symbol, just to repeat for those who are interested to see the futures price or in Shanghai converted to dollars, is AG1 exclamation mark. That gives you, first of all, the price per kilo in renminbi. But if you want to see it in dollars, you do equals AG1 exclamation mark divided by 32.1507 divided by USD CNY.
Beyond gold and silver, other precious metals offer insight into broader supply dynamics. Platinum has staged a strong rebound after years of stagnation, supported by persistent supply deficits projected several years ahead. Palladium, while volatile, has seen sharp price swings as markets debate whether current shortages will turn into future surpluses. These movements highlight how sensitive industrial metals are to shifts in demand, technology, and substitution. Together, platinum and palladium reinforce a key theme. Precious metals are no longer moving in isolation, but as part of a wider rebalancing in global commodity markets.
The division by 32.1507 takes your kilos down to ounces, and then the USD CNY converts the renminbi price in ounces now to a US dollar price. Now, if you want to do it in a very exciting way and find out how the difference has been between the COMEX price, the spot month, and the Shanghai spot month has been changing, you take that formula, which I just said, which is AG1 exclamation mark divided by 32.1507 divided by USD CNY, and subtract minus SI1 exclamation mark. So that will give you the difference between the Shanghai spot price and the COMEX spot price. And if you do that, you'll see you get, when I did it a few seconds ago, I got a figure of $5.13, which was the difference at the time. That figure might change by the time you do it. Let's talk about a message I've received from somebody who said, I went into cash in January, 100% cash, and I felt a bit left out because the market continued rising, and then there was a dip in April, May, and I went back partially in, but I was still 67% in cash, and I'm feeling very left out of it. I'm sure I'm not the only one. I've got lots of friends who did the same thing, and I'm worried because the market just keeps going higher, and I feel I'm missing out. What do I do? Look, first of all, I'm really sorry. The decision you made was to, well, there was a lot of bearishness around at the start of the year. People were saying there's going to be a crash, there's going to be a crash. And they've been saying it all year, but that's not new. Ever since I've been investing in 50 years, there's been armies of people forecasting a crash is just around the corner. So it's always, if you feel a little bit nervous, there's always a temptation as to an excuse to get out, because you can find somebody easily who's forecasting there's going to be a crash. So I'm sorry you got out, and I'm sorry you missed out on this huge rally. Obviously, getting back in a bit, you did make some money on the bit you got back in. So if you're at 66% or something like that in investments at the moment,
Rising markets bring emotional challenges. Many investors who moved to cash earlier now feel sidelined as prices continue climbing. This tension is not new. For decades, predictions of imminent crashes have coexisted with long bull markets. The result is paralysis, fear of buying too late versus fear of losing capital. A disciplined response is gradual entry. Investing in small increments reduces emotional pressure and limits regret. Focusing on financially strong, resilient companies or diversified assets can also ease anxiety, ensuring portfolios remain durable even if markets experience corrections.
So if you're at 60% cash, presumably you're 40% invested, it's not too bad. You had some of the rally. But what do you do? Because obviously there's still these predictions of a crash around the corner, and there always will be. So you have to remember, when you're investing, no matter when you're investing, there'll always be someone out there in the newspapers, on TV, or wherever, saying things are about to crash. And it can be very off-putting, and you're very nervous that you buy and you're the last fool, the market's about to go down. So how would I deal with that? Well, I think the way to deal with it is to invest very small amounts gradually, so that if it goes up, at least you can feel you're making moves in the right direction. And if it goes down, you can think, well, at least I held a lot back for the crash. But that's all you can do, really. Invest a little bit at a time. And the other thing you can do is, if you're nervous about the markets, don't buy speculative investments. Buy the most solid companies you can find. And I've done this video about how to build a portfolio and pick investments. I think it's called something like the Beat the Benchmark 2026 portfolio. You can look on my YouTube channel and find it. And it tells you how to pick really good stocks. So what you want to do is buy companies which are relatively safe. I show you how to do that in the video. Companies which are strong, which are showing growth. And if you pick those rather strong blue chip companies, even if we have a crash, you can feel less nervous because you're pretty sure that the stocks will still be around. What are the portfolio managers doing about gold and silver? Well, we're hearing that many investment banks are starting to say that gold could be part of the portfolio going forwards. Why are they saying that? Well, the mathematicians are sitting down and doing the maths on what gold would have done, and I'm talking mainly gold more than silver, what gold would have done if it had been in the portfolio for the whole of 2025, 24, 23. And the maths will say that you would have had lower volatility and higher returns. So basically that means that they're going to start putting this gold and silver into portfolios in 2026. Now, it does take time for big firms to make a change in their asset allocation. There's a whole slew of things which have to be looked at. They have to look at the legal side. Is it allowed for certain portfolios? Is it allowed in the country? They have to look at how they're going to do it. What instruments will we use to get exposure to gold? They have to look at things like the custody arrangements. If we buy gold, how are we going to custody it? They've got to look at the agreements they got with their various counterparties. They've got to look at the customer mandates and see if the documentation allows them to do what they want to do. So there's a whole bunch of things. And then, of course, they've got to bring on board the chief investment officer, the investment committee, the senior management of the bank, and so forth. So it's not a straightforward process to put gold in the portfolio, but they've had a good year of strong gold rises, so it must have been discussed. And I think that many banks are starting to add it. Now, I've had a few banks already write to me with a 2026 letter, and I see the word gold being mentioned several times now. So I think that come 2026, portfolio managers will be starting to put gold into the portfolios. And I think right now, one of the things which is happening is that some of them are moving ahead of time. They're saying, what's going to happen when we present our portfolio for 2025, the 31st December 2025 portfolio to our clients? Every year, the clients always say, did you own da-da-da, whatever it happened to be. Maybe last year it was Nvidia, this year it'll be gold. So clients who've got investment portfolios tend to say to their portfolio managers, did you own, and then they name whatever they think would have been the best investment, Bitcoin, gold, Nvidia, technology, doesn't matter. So what you do as a portfolio manager is you start to think, how can I answer that question in a way where at least I say, no, I never thought of it. Well, the way you do that is before you get to the end of the year, you buy some gold. So when the question is asked, you say, yeah, don't worry, I've got some gold. And oh, well, you can brush over how it's doing. The fact you just bought it last week and it hasn't yet had much time to perform isn't really that relevant. The important point is you're on the thing which the client perceives to be the fastest moving asset on the planet at the moment. So I think there's a lot of, let's call it window dressing going on with portfolio managers putting gold into the portfolio at the moment in order to spruce up the portfolio, make it look more beautiful, show that they haven't missed out on the best asset in the world, even though they have.
Institutional attitudes toward gold are quietly shifting. Large banks and asset managers are reassessing portfolios and finding that gold would have reduced volatility while improving returns in recent years. As a result, gold is increasingly mentioned in forward-looking allocation plans, particularly for 2026. Implementation takes time. Legal reviews, custody arrangements, and committee approvals all slow the process. Still, some managers are moving early. Holding even a small gold position allows them to tell clients they participated in one of the year's strongest assets. This window dressing may be modest now, but it could grow into sustained institutional demand.